Hello everyone, my name is Reese, and in this video I will be talking all about dividend investing, why it is so popular and the pros and cons associated with it, and who is dividend investing really suited for depending on, your personal financial situation. So to start off, what is dividend investing? Dividend investing is a form of investing that many people consider to be a form of passive income. And what dividend is when you invest in a company as a shareholder, you may be entitled to a portion of the company's profits depending on how the company is set up. And if the company pays dividends and you are a shareholder, you are technically a part owner of the company, and therefore you are entitled to some of the percentage of the company profits. And not every company will pay dividends. It really depends. Typically, dividends are going to be more associated with companies such as like in the financial sector, energy companies, utilities such as Verizon, AT&T. So, and then this consumer staples such as Procter and Gamble, Johnson and Johnson, Coca-Cola, Pepsi. So there's many companies out there that do pay dividends, but when you are a dividend investor, you're basically targeting dividend-paying companies to try and seek out a passive income. And dividend investing is pretty nice because if you reinvest your dividends, you can buy more shares, and in the future you're having the company buy shares of itself through dividends, and over time that can compound to significant returns in the future. And even if you don't reinvest your dividends, you can use those dividends to supplement your income or even live off your dividends entirely, depending on how large your portfolio. And within dividend investing, there is two groups. There is high yield dividend companies and then high growth dividend companies. And I've done a video about this before, if you are not as familiar with the topic, I think you should check it out. But essentially, the key takeaways of that video is what we found is that high yield companies are companies with higher payout ratios, which means that more of their profits are being paid out to their investors. So these companies are having high dividend yields, but the sacrifice is what you're paying for the high dividend yield is less capital appreciation of the share price typically. Whereas companies who have higher dividend growth rates and a history of growing their company as a whole typically are going to have lower overall dividend yields in exchange for higher capital growth through the share price appreciation. And what's nice about dividend investing and why I think it's really appealing to some people is typically if you're investing in a solid company or dividend paying fund, what is nice is, let's say your portfolio is in a market downturn as we are now, or during the Great Recession, or even during the COVID sell-off. If you are someone who was in a position where you needed your income, and if you were in a position to have to sell shares, and let's say if you were investing in growth companies, which usually pay little to no dividends, with dividend investing, ideally they're going to keep paying out their dividends no matter what. Now, when you're investing in individual companies, if a company does cut back its dividend, it usually hurts the share price considerably, and there's usually a sell-off. But when you're investing in dividend ETFs, these are going to keep paying out their dividends, usually on a quarterly schedule. Sometimes they'll be in a monthly schedule. It just really depends on the specific company or investment ETF. But with dividends, you can ride out any downturns without feeling the pressure to sell your shares if you need the income, because they're going to keep providing you those dividends. You can either reinvest them or withdraw those dividends as cash, and you're still getting your passive income regardless of how the market is performing. If you get your dividend portfolio large enough to where you're getting reliable income, you could get in a position where you can never even worry about looking at your portfolio, because as long as you're getting your dividends, it doesn't matter what the stock market's really doing at the end of the day, because you've reached your investment goal. So that's kind of an overview of what dividend investing is as a whole. And dividend investing is usually more so for people who are looking for potentially overall lower volatility with their portfolio, as well as if they're in a position where they're seeking those dividends as a form of income for whatever purpose to fit their needs. And I'm going to be doing a video comparing dividends to growth companies, to dividend paying companies to growth companies, to kind of see, compare and contrast the two, categories of funds. But at the end of the day, I think dividend investing is a pretty sweet deal if you're someone who fits, who dividend investing is really suited for. So the cons with dividend investing is, even if you're going with a high dividend growth company, usually you're going to get less overall capital appreciation compared to, let's say, a growth fund or potentially even the S&P 500, depending on the company you're investing in. So in exchange for getting your, returns through dividends, you are potentially not seeing as much capital appreciation as if you were to invest in an overall market fund or a growth fund that's going to have, tech heavy companies. But I think in a diversified, well-balanced portfolio, I think you can definitely include some ETFs, dividend-paying ETFs in there to complement a core holding such as VU or VTI, which is a S&P 500 or total market fund ETF. And I personally have some percentage allocations to some dividend-paying ETFs because I really think they're a nice complement. It's not my personal focus to be my main, form of investment, but I do think they have a great time and place if it suits your needs. So now that's a little overview of dividends. And the last thing you need to know when you're investing with dividends is in order to calculate how much yield or how much money you'll actually get out per year of dividends, you need to know the yield of the particular stock or company. So let's say the S&P 500 as a whole right now, I think they have a 1.7% dividend yield. So if you were to invest in an S&P 500 index ETF, you'd get 1.7% yield. So if you put in $100,000 or per $100, you'll get $1.7. So if you invest $100,000 into it, you'll get $1,700 per year through dividends. And over time, historically, depending on what you're specifically investing in, ideally you're wanting to invest in something that has growing dividends, because over time those dividends are going to get larger and larger, especially if you're compounding your investments by reinvesting those dividends. Those increasing dividends will really show up in the end. And usually dividend-paying funds might have an dividend yield between 2 and 4% on average, depending on their specific goals. And as I mentioned, usually the higher the yield you're getting, usually the less capital appreciation. So with all that out of the way, I'm going to talk a little bit about a neat website called ETF.com, which is something that you can use to help not just with dividend ETFs, but many other categories as well. So you can go to view all channels. Let's wait for it to load. So we can see basically hundreds of ETFs. There is crazy amounts of ETFs out there. But for this video, we will be talking about, where is it? Dividend ETFs. So an ETF is basically a composition of stocks, or usually it's going to be managed by an investment broker such as Vanguard, Schwab, BlackRock, iShares, Fidelity. So that's being managed by a broker, and they're basically compiling different stocks together to meet the goal of the fund. So for example, if we go to scroll down and we can sort by assets under management, which means that these are going to be the most popular funds by capital, we'll see like Vanguard Dividend Appreciation, and that is going to be a fund targeted towards investing in companies with a history of increasing their dividend. And then VYM is High Dividend Yield, which is focusing on companies with above average dividend yields. And then another really popular ETF is the Schwab US Dividend Equity ETF, which tracks the Dow Jones 100 Index, which I could do a video separately just over this ETF because I really think it's pretty sweet. And what's nice is you can see your expense ratios. Really, we want the lowest expense ratio possible for a particular fund set that we want. So, because the lower the expense ratio, the lower amount of fees you're going to be paying, the less money that's getting taken out of your pocket going to the broker. And that's really nice about Vanguard, is they're known to have low expense ratios. And so not only are these the most popular by assets under management, they also have the lowest expense ratios really out there. And it's important to take assets under management into account, because that is telling you how liquid the portfolio is, how easy it is to buy and sell shares, because you don't want to be in a super low asset under management fund that doesn't have a lot of shares, because that might make it harder to buy or even sell. So it's good to keep that in mind. And I think there's a reason why these are the most popular ETFs out there, because they have low expense ratios and a history of good yields. So on ETF.com, we can open up these funds. So VIG, which is a Vanguard Dividend Appreciation Fund, we can scroll down and see it has a distribution yield of 1.97%. So a little bit higher than the overall stock market. We can see where it's investing, the sectors it's in, and the holdings as well. And this website's pretty neat, because you can see basically how well it's doing. So this has a rating of an A. VYM also has a rating of an A. I'm not sure what the 65 mountain VIG, but VYM has a 3.07% yield, and that is 1%, a little over 1% higher than VIG, because this is focusing on high dividend payments. And then SCHD has a dividend yield of 3.42% as of right now. So it actually has the highest dividend yield out of all of them. So using this tool, you can find out what is in these funds, what their yield is, and then you can use that yield to calculate, what your expected dividend payments are. And remember, over time, these dividends are going to hopefully increase, so you can getting larger and larger dividend payments over time. And then you can also go to vanguard.com, and you can find more information directly about VIG or VYM. You can also go to the Schwab SCHD and really dig into, into shares. Like, you can go through everything that you want to know about what it's tracking, the performance metrics of it year to date. You can scroll down some more and really just basically find out anything you want to find out about these funds, because as ETFs, they're required to really disclose everything about it. And you can even go to like portfolio composition. You can just figure out everything you need to know, and you can even go through and see all the individual stocks, all their holdings, how much percentage is allocated to each. So it's good to know what you're actually buying. And let's see, now that I've done a lot of research on this, and I think that VIG, VYM, and SCHD are the top 3 dividend ETFs out there, and at doing what they are meant to do. So let's go into portfoliobacktester.com. And here we have we're basically backtesting how you would have done if you had invested in these funds. And so this is a hypothetical situation of investing $5,000 with an initial investment of $5,000 with ongoing monthly contributions of $1,000 per month. And it is going to be using SCHD, VYM, and VIG, so the Schwab Dividend Equity, High Dividend Yield, and Dividend Growth funds. And then we'll be comparing it to VU, which is an S&P 500 ETF. And when we compare them all against each other, this is how things would have looked. In the end, SCHD was the top performer in blue. VU, which is in green, is the second best performer. And then VIG and VYM were the bottom 2. When I say bottom, that doesn't say I mean bad. They're still getting overall pretty good returns. If we scroll down, 10-year returns, S&P 500 at 11.6, dividend growth at 10.3 or 10.7. high dividend yield at 9.9, and SCHD at 12.11. So overall, SCHD has actually had the best returns overall. And if we go down to portfolio income, what blue is SCHD. This is like back testing how much income you would have been expected to see. SCHD actually has been paying out more in dividends than VYM because it has a higher dividend yield as of right now. Now, that doesn't mean these funds will always perform the same moving forwards. It's just kind of a back test to see how they would have done. And the reason why people are like dividend funds is even if you're, say, VYM, which is getting lower returns than some of the other options, the reason why it still might be a good choice is because it is going to offer less volatility. So let's say, look at this worst year category. So the S&P 500's worst year was a return of minus 24% since 2012. And VYM's worst return was minus 13.5%. So even if it's not going up as much, it's still going up by a decent amount. It's not getting sold off as much. We go down to the trailing 1 year return, S&P 500 down minus 15%, dividend growth minus 10, VYM minus 5, and SCHD minus 7. So as we can see, these dividend funds are holding their ground because as usually these dividend paying funds and companies are going to be a little bit stronger financially, hopefully, than compared to potentially some of these growth stocks that may not be as financially sound. So when macroeconomic trends change, what was favorable for growth companies then might not be as favorable now. And so the conditions are kind of starting to hurt growth companies, especially as they're getting interest rates that are on the rise. It's getting harder for them to get access to cheap capital, and that is making growing as a whole more difficult. And that's where these dividend funds can really shine because they've already been established with a history of dividend payments. And not all dividend funds are going to be created equally. There can be two funds that have the same dividend yield, but the underlying companies may not be very fundamentally sound. So that's why it's good to do your research, see what's actually in them. There's a pretty neat website called ETF Research Center where you can do fund overlaps to kind of type in two ETFs and you can see what their overlap is with each other. And because it helps show that how much of the ETFs actually are in the same, like how much of the holdings are actually the same. So ideally you want to try to not get funds with a lot of overlap. For example, DGROW, which is a very popular iShares dividend appreciation fund, basically in competition with VIG. DGROW has a higher expense ratio and it has 66% of the same holdings as VIG. And because of that, it's why I don't include DGROW in my top 3 dividend ETFs, because they have a higher expense ratio, less assets under management, and it's seeking basically the same goals as VIG at the end of the day. So I personally feel a little more at ease with VIG. And let's see, going in back to comparing. So this is TradingView, which is comparing lump sum performance of basically how funds have been returning over time. So this is going to be a little bit different from Portfolio Backtester, which is counting ongoing contributions. This is counting it as just one lump sum and then relative returns. So in orange, we have VYM, high dividend yield, and VIG in blue, which is a dividend appreciation fund. And as we can see, depending since basically 2011, this is without reinvesting dividends. There's been periods where the high dividend yield companies were doing better, and then as of right now, the dividend appreciation companies are doing better. But when we reinvest those dividends, suddenly the picture changes a little bit, and we're seeing that both funds at the end are performing pretty similarly. And then if we go to year-to-date returns, the high dividend yield is really showing its ground. If we compare that to the S&P 500 at the bottom in purple, high dividend yielding companies as of right now are really holding their weight. and we compare to the SCHD, which is a very popular fund. It's, let me see, zoom out. So overall, they're still lagging the overall market for the most part. SCHD is actually the top performer as of right now. But as I mentioned, when you're investing in these dividend paying funds, you're not necessarily trying to beat the market. You're trying to perform an alternative investment style that will provide you more financial stability and a form of passive income. So really, dividend paying funds and stocks, dividend investing is more directed for people who are wanting to diversify their portfolio a little bit to be a little less aggressive, a little less volatile, and they're wanting to start compounding their dividends or use that dividends to supplement their lifestyle. Now, because think of this, if especially you have a long time horizon, you want to be a little bit more stock heavy, a little more aggressive with your investing style. But as you're getting closer to retirement age, that's when dividends and bonds can be really great, because then you're starting to supplement your lifestyle. And if you get your dividends or interest through bonds to be large enough to completely support your lifestyle without having to worry about selling your shares, you're in an amazing position. Because if, as I mentioned before, if you're invested in S&P 500 funds or growth funds that are going to have lower dividend yields relative to dividend paying funds, you might find yourself in situations where you're having to sell off your portfolio, even if you're in a market downturn, which you really don't want to be in a position, because when you're in a downturn, in a market bottom, that's when you want to be buying shares if possible, not selling. So it's good to, I think dividend funds can really shine in situations like that, because they can help carry your portfolio through downturns and just make everything make you a little bit more at ease. So I personally have the S&P 500 or total market funds allocated to be my main investment personally, but I'm complementing that with these three dividend paying funds. And even though the high dividend yield is not, as performing as great as some of these other funds just in the long run, I still think it's good to have as an addition, because that can compound itself over time to the point where you're getting significant dividend payouts. So I hope all that made sense. And these basically what we went through is this website called ETF.com, which has a database for thousands of ETFs out there. And you can go into categories. We go into the dividend paying section, and we can see what the most popular ones are assets under management wise. We talk about having a good expense ratio is ideal, because you're going to be paying less overall in fees. You know how to see what your dividend yield is, and you can see what your basically the holdings are, the sectors, what its goals are, what the index is tracking. And what's good about this is you can see what companies actually make the cut. So for VIG, it's companies that have increased their dividend yield or dividend payments for 10 years or more. VYM is basically just approaching for basically high dividend yields. And then SCHD is pretty great, because it is basically using screens to calculate fundamental financial strength, high dividend growth rate, and high dividend yield. So, and it also excludes REITs, REITs. One important thing I forgot to talk about with these three dividend paying funds is that they count as qualified dividends, meaning these dividends are not going to be taxed at a regular income tax rate. They are taxed as capital gains, so that is getting preferred tax brackets. And if your total capital gains taxes are under $40,000 a year, I believe it's taxed at a 0% federal tax rate. With, you do have to pay Medicare, Social Security, and those lower taxes, but you can really save a lot of money by investing in these dividend paying funds that are paying out qualified dividends, because that's saving you money on taxes, and these are saving you money on expenses. So I hope all that made sense. And the pros and cons made sense as well, because as I said, some of the cons with dividend investing as a whole is you are potentially missing out on some of the gains that more tech-heavy funds and growth-style funds may achieve over time. But this is a form of stability. This is a form of diversifying your portfolio to get, stable returns rather than potentially hitting home runs and then missing some. This is going to be consistently hitting the ball, getting you singles, getting you on the bases, and it's over time. Dividend investing is a winning strategy, even if it's not completely outperforming the market. It's still, I think, a very solid choice for someone who it just wants to diversify their portfolio to be a little bit more financially strong, because this is going to be more value-based companies. Hope all that made sense. I will be providing all these links in the description down below. Thank you guys for watching. I know these videos do tend to go a little bit longer as I start talking, but I'm really trying to give you all the information that I can so that you can be as well equipped as possible to make these decisions for your own. I'm trying to present information that I find, how I find it, and why I lean towards some things over another. But I'm not trying to tell you that these are the 3 funds you need to go out there and buy. Please remember that. It's simply trying to put it on your radar so you can inform yourself to be more well equipped with the skills and mindset to build a portfolio that works for you. I'm not a financial advisor. I'm not telling you to buy these stocks. I'm simply saying this is what works for me. This is why I like them, and this is why I think it should be at least on your radar so that you can know if it would be a fit for you or why not, so that you can be better equipped to make these decisions for yourself. So thank you guys for watching. If you have any content suggestions or feedback, feel free to leave a comment below. I'd be more than happy to take a look and see what I can do about it. Thank you guys for watching. If you enjoyed this content and want to see more, feel free to subscribe. It is free, helps support the channel, and helps encourage me to keep these videos rolling. Thank you guys for watching. Have a great one. Peace out.